Good morning, everyone. Thanks for joining us on the webinar today. Today's webinar is being presented by Scott Stone. The title of the webinar is The Financial Markets and the Economy, What to Look For in 2017. Just a little bit of a background information regarding Scott Stone. Scott is a Senior Vice President at PENTAK. He is our Chief Investment Officer for the PENTAK organization, which manages about $11 billion of assets for both public and private holdings, including fixed income, equity, real estate, and alternative investments, including hedge funds. Scott is a chartered financial analyst and a fellow of the Life Management Institute. He received his BS and MBA degrees from the University of Kansas. With that introduction, Scott, the floor is yours.
Thank you, Rich. Good morning, everyone, and welcome to the first investments-led PENTAK that we've been able to get together here. I want to thank, first of all, Fred and Chris. As always, everything here at PENTAK is a team effort. Fred Slade, our resident PhD in economics and our chief strategist, as well as Chris Lamarca, one of the members of our institutional solutions team, managing director on that team. He and Fred and I kind of put this thing together and hope that you'll find some use in our little musings as we start 2017. So what are we going to talk about today? First of all, importance of asset allocation. It's a big part of what we do here at PENTAK for our clients is allocate their investment assets to the various sectors. And we'll talk a little bit about what that means and where we're looking these days, some of our concerns and risks. And finally, this mysterious place called Trumplandia and what it looks like. I think there's a lot of market turmoil and for the most part, I would call it confusion more than anything else about what's going to happen next. I think certain members of the trading community have decided that they're pretty sure what's going to happen, but I'm not sure the rest of us have. As we talk about asset allocation, let's talk about our view of the markets here. We published this graph for a lot of our clients and have been doing so for a number of years. And this is a sort of an update or a modification, if you will, to the Merton Miller and Markowitz and William Sharp capital asset pricing model. The security market line is that red curved line that you see through there. It's not necessarily the CAPM that you're traditionally used to, but it is, the version of the CAPM as applied to securities markets today. The horizontal axis on the bottom runs from low risk on the left to high risk on the right, and low return at the bottom and high return at the top on the horizontal or the vertical axis. So what the red curved line means is that as you travel through the securities markets and you take on more risk, the marginal risk is less, or the marginal risk is greater and greater, and the marginal return is less and less. So the more risk you take on, generally speaking, over time, what has happened is you don't add as much return as you did from the last unit of risk. On the left-hand side is pretty much the fixed income universe. It's highlighted in the blue kind of rectangular box on the left-hand side of the graph. And cash and money market funds tend to be the lowest risk. High grade and then high yield funds tend to be a little bit higher risk. Then you move right and you get into equities, large cap, mid cap, small cap, international. And then finally you get into alternatives and commodities and real estate, which tend to be the riskiest of all assets. Security market line represents the publicly traded markets. The private markets, on the other hand, because there is a private market liquidity premium, you could almost think of that as having almost the same amounts of risk per sector, but an additional premium in return and perhaps a slightly different, slightly higher risk premium because of the liquidity, the risk that's involved. We draw the dots around these lines to show you the universe of the funds that are out there. Index funds, passively managed funds, tend to have a very tight correlation and tend to be right on whatever the security market line is. That is, you're getting the return For instance, in a large cap fund, you're getting the return of the S&P 500, for instance, or maybe the Russell 1000, and it's a very tight range. Those funds and the indexes that they're benchmarked to kind of a fairly tight correlation range. Whereas the actively managed funds, those orange dots, there's a bigger universe of those, and most of the orange dot lies below the line because according to the Standard & Poor's Index versus Actives, or SPIVA reports, which have been published for many years now, routinely active managers only outperform the index maybe 10 to 25% of the time. For the most part, active managers underperform the indexes in any given period, which is why you see the kind of the overlay. And the red actively managed funds that are in the private universe tend to have a much larger dispersion around whatever mean they have, and that mean, on average, according to academic research, the blue line over the red line is about 300 basis points. That's an average. It exists over time, and it changes. But it is, there's definitely a premium, and there's definitely a wider group. So as we look at the markets, you can see as you're making asset allocations, which of these markets tends to be more risky and more return, and less risky and less return. So moving ahead, how do we do things here at Pentegra? Well, first of all, for most of our pension and 401k clients, what we're doing here is we're putting liquidity first. And what that means is we generate cash when it's needed naturally. That is, whatever fixed income or other investments that have actual maturities, that have predictable cash flows. When we make that allocation, we start with how much cash does the client need to generate for their defined benefit plan in the first year, the second year, the third year, however many years the client can stand to go forward. We generally speak to the client about the notion that you want to be able to generate that cash naturally. You don't want to be a forced buyer or a forced seller in order to meet your cash obligations. So consequently, you avoid paying liquidity premiums. You avoid surrendering years of successful returns, because at a bad moment in the market, you might be forced to sell, and that is usually a recipe for losing hundreds, if not thousands, of basis points of the return you've accumulated over the years. So generate cash when you need the cash is sort of our motto. Second thing that we also look at that's very important to us is correlations and valuations. That is, the correlation between the various asset classes, stocks and bonds. That pink highlighted section you saw in the graph versus the blue highlighted section, the blue versus the gold highlighted section, and so forth. What we're trying to do is establish that portfolio diversification is best achieved when you have zero or negative correlations between the various asset classes you select. That adds return per unit of risk, and it's very important then to understand what those correlations mean when you're constructing a portfolio that's actually pretty efficient. Return targets, if you look at the capital market assumptions of JP Morgan or BlackRock or some of the larger organizations out there, you'll see that for the most part, they're expecting 7 to 8% returns for portfolios going forward. Now, that brings us to our first quiz of the day, which is, what is the annualized total rate of return for the S&P 500 in the 21st century? And for clarity purposes, we're going to talk about the return with dividends reinvested into the index, calculated on a monthly basis from December 31st, 1999. We're going to say the 21st century started in 2000, popularly as versus as a few pedants have said, really technically it's 2001 was the first year. We're going to call it 2000. So 17 years, monthly returns, dividends reinvested in the index to December 31st, 2016. I'll give you a few data points before I give you the answer, and you can think about what your guess would be. From 1980 to the present, the S&P 500 yielded 11.5%. It was an 11.5% return, dividends all in per annum. From 1990 to the present, it was 9.34% dividends reinvested. Currently, J.P. Morgan's capital markets assumptions only estimates a 6.25% long-term return for the large cap stocks as indicated by the S&P 500. So with those numbers in mind, the actual number is in fact 4.51%. And that's not very high. It's probably a lot lower than a lot of people would guess it to have been. If you look at where the valuations were in 1999, it was a very special time in the markets because that was the height of the dot-com bubble. By the end of 2000, the NASDAQ had been cut in half, and the S&P, and as you'll see in a moment, was down pretty substantially as well. What you're looking at now on the presentation page is the price to EBITDA valuation of the S&P 500 since 1999. And you can see that it's over 11 times today, 11.3 times. The only time in the history that we've tracked that, we've got data going back to the 1980s. There's only 2 times it's ever been over 11. And one was at the height of the dot-com bubble, and the other one is now recently. I don't think there's anything magic to the number 11, but we do think that the price to EBITDA valuation, which is popularly used to value private assets as well as public assets, publicly traded assets, is at an all-time high. We also focus on this because, as opposed to price to earnings, it's a little bit more consistent in the sense that PE has changed because earnings have changed in this period of time, with the FASB no longer amortizing goodwill and other items out of earnings. So the EBITDA kind of cleans that up, if you will, and allows us to make an apples-to-apples comparison pre-1999, post-1999. Moving forward, what did that mean for returns? Well, if you'd invested your money at the end of 1999 on December 31st and gotten the close of the day pricing for your stock investments in the S&P 500, at the end of 1 year you would have lost 9%. At the end of 2 years, at the end of 2001, in the wake of 9/11, you would have lost 10.5% each year. These are annualized returns. By the third year, you would have lost 14.5%. It took you until 2007 to basically, between dividends and appreciation, earn back your investment from 1999. And of course, by the end of 2008, in the early part of 2009, you'd lost it again. So basically, the point is that the last time we saw a price to EBITDA valuation of 11, we had essentially followed by a lost decade of stock returns. Stocks did not earn anywhere near the 4.5% that has been the average since then, and certainly nowhere near the previous averages or even the current capital market assumptions. Returns were, for the most part, negative for the following decade cumulatively. There was volatility in there, and we're going to show you now some of that volatility, as well as some of the correlations. We use a regression method to estimate equity duration here. And you'll see that the blue and red lines below are essentially a duration estimate, but they're also essentially a correlation can be used as a proxy for the correlation between U.S. Treasury notes and bonds and the S&P 500. And as you can see, starting with the long-term capital management crisis in the late 1990s, the volatility would spike, and suddenly correlations went from positive to negative. I'll tell you that our data indicates that from about 1960 up until 1997, 1998, the stock bond price correlation was actually positive. It became negative in 1998, stayed negative for most of that crisis period, went to zero in the housing bubble years, of the final years of the housing bubble, before in the 2008 financial crisis again going negative. Most recently, the red line, which is the 1 quarter running statistical correlation, has actually turned positive again for the first time in 17 years. It rapidly went back to zero where it sits today. But correlations, the point that we want to make here is that correlations between stocks and bonds are not stable. And in fact, between treasury bonds, the risk-free rate, they have been negative for most of the last 18, 19 years. Correlations between the U.S. and developed countries, the MSCI EFA, have also gone up in this same period of time. So equity correlations globally are getting more and more correlated with each other, while stock and bond correlations became negative. So you've got better diversification from U.S. Treasury notes and bonds than you ever would have gotten from the EFA over that period of time. It's an interesting takeaway, and again, these relationships are not stable. They do change over time. Something else that matters is real rates. When we talk about the risks and the forecasted returns that we're looking at, this is the 10-year Treasury less the year-over-year inflation. That's something that peaked back in the early 2000s at over 400 or 500 basis points. Today, it is standing at a scant 38, 39 basis points, and then most recently now 26, 27 basis points. So if real rates are falling, can nominal rates be far behind? That is, if the real rate or risk-free rate on a real basis is turning into almost nothing, then most every other risk that you take is a premium over nothing or over a negative value. To the extent that those real rates are falling, absolute returns have to be falling as well. And in fact, they have been. Risk premiums also matter. Another thing that we track here is market risk premiums for a number of different assets, including high yield, which tends to be fairly correlated to the other, to equity or equity-like markets. As you can see, the peak of this graph occurred on February 11th, which was also the most recent cyclical low in stocks. So since then, the risk premium has been coming out of the market. That is, the risk to hold risky corporate assets, whether they be stocks or bonds. You could argue that that risk premium is falling, and therefore the prices are rising, both for high yield and for equity. And that, in fact, did happen in 2016. High yield and equities both performed very, very well. So that's what's been happening. That's what we look at. Now let's talk about some of the risks and concerns that we have going forward. We're going to start with Europe. European banking is giving us pause and has for a number of years. If you look at the statistics here compiled by our friend Mr. Lamarca, there's 19 trillion dollars in U.S. or 18 trillion euros outstanding in government financial institution debt in Europe, 11 trillion in government, 7 trillion in financial institutions. German banks hold 30% of all that debt, France another 12. And together they have half of all governmental bonds, about 2 trillion each. German GDP at 3.1 trillion, and their debt 64%. France 2.2, 90% of GDP, and Italy gets to be a little scary with government debt alone in Italy, and I don't believe that counts the agency and other local debt. That's just federal government debt, 125% of GDP. So Italy is of particular concern when it comes to banking and when it comes to leverage in their financial systems, and you can see why here as well. The percentage of non-performing loans is not just the leverage, it's what that leverage is doing on those balance sheets. And we can see here that Italy has an 18% non-performing loan in its bank system, which is rather shocking. Greece, as we know, had to be bailed out. Greece essentially has about 60, 70 billion euro outstanding of government debts. Italy, as you saw, 1.6 trillion. So to the extent that Italy, maybe they don't have as many percentage of non-performing loans, but compared to the U.S., it's astronomical. Compared to the rest of Europe, it's still 3 times what you see in the rest of Europe. For a debt market with a GDP and a debt market that are smaller than what they would need to be able to handle that kind of non-performing loan. So what's behind Italy now? You've been hearing perhaps since Brexit that the Netherlands or Italy might be the next to leave, and certainly some events in the recent past, particularly the referendum last month, has sparked a lot of people to wonder if Italy might be the next nation state to renounce the euro and the eurozone. What's going on in the banking there is financially a big, is perhaps an important piece of that. The government recently said that they would try to raise a $20 billion fund, and they've essentially set that aside in their budget to bail out the banking system, or perhaps bail it in, because in Italy, the next point is that bank crisis bailouts can also include bail-ins, which means the equity or debt conversions or debt-to-equity conversions for bank deposits as well as loans. So they can essentially create in Italy a better solvency simply by converting the people who have loaned money to banks into equity holders in those banks. Now that's also involves some nuances, including potential bailout of those investors who got converted. That's also in the bank, in their banking system laws. Italy's Unicredit SPA has 80 billion of those non-performing loans. Between 18-20% of them, I think a little over 20% now. And they're going to try to raise 13 billion themselves, in addition to the $20 billion bank bailout fund that's already there. And they're already in the process of bailing out the Banca Monte dei Paschi, which was founded before Columbus sailed. And that's estimated to be 7 to 9 billion. So the $20 billion fund, in reference to this, would disappear just with potentially those two banks and the capital they need. If you were to translate this non-performing loan to U.S. scale, essentially, Italy has 1/10 the GDP of the U.S., and if, for round numbers, we assume there's a relative parity there. You simply multiply the 360 billion euro of their NPLs by 10 to get 3.6 trillion. The total loans in the U.S.'s big four banks, Wells Fargo, B of A, J.P. Morgan, Citigroup, is less than that. So imagine a banking crisis in the major banks of your system that was equal to these types of percentages of the loans in the system. Now remember, in the U.S., our loans and our loan activity is smaller because in Europe, they tend to rely to the tune of 2 to 3 times more on their banks for loans and for lending capital than we do in the U.S. because we have a lot of non-bank lenders in the U.S. So that's part of why that seems so big. But the reality is, in a banking system, a regulated banking system, to have that kind of non-performing loans, you're talking about a serious banking and solvency problem that has implications for a deflationary force coming out of that part of Europe. What's really driving Italy? Well, politically, it was motivated by their five-star movement. And that is a movement that is more focused on environmental issues like clean water, publicly safe water, sustainability of development, sustainability of the environment, and so forth. That was the 3 of the 5 points that they were established on. They are also very populist in nature and advocate a direct vote as opposed to a more Republican or an electoral college type of allocation, as is popular in the rest of the Western world. They're very anti-establishment, founded by political outsiders, similar to and sympathetic to UKIP and Nigel Farage in the British Parliament. And they are supported broadly from both left and right, people who feel marginalized. That may sound a little familiar to what would be called the Trump coalition in the United States. Immigration for this group hasn't really been a major issue except recently when they have come out against keeping undocumented illegal aliens, particularly from the Middle East, in their country. The failure of the referendum, which was going to simplify government, reduce the size of the legislatures in Italy, that failed, and Renzi staked his former prime minister staked his future on it. Essentially, that failed, and that's another reason why Italy is being mentioned. The reality is, though, it seems to be in the background. If you look at the German 10-year bond and the Italian 10-year bond, both denominated in euros. Germany representing the highest quality, if you will, in Europe, and Italy presenting the lower end of the quality spectrum. The spread is only about 160 basis points on those bonds in the 10-year sector. This has been widening all through 2016. However, it's no wider than it was in 2014 and certainly much narrower than the 550 basis point premium at the end of 2011 during the Greek crisis, when there was a system-wide systemic failure possibility being discounted by the markets. That's not there anymore, but it certainly is a possibility that you have to keep an eye on. Let's move from Italy now to Germany and what's going on with Angela Merkel, who's the leader of the CDU, has three-term essentially president in Germany, and is running for a fourth term now as of September 24th of this year. Her approval ratings have plunged from over 70% just around less than 2 years ago to 45% December before that mall attack, that Christmas terrorist attack on the mall in Germany. It's expected that her approval ratings are going to continue to fall. She has been very globalist, very pro-immigration, and essentially the last foreign leader to receive a goodbye call from President Obama, who spent some time talking to her. They tend to be ideologically aligned. She has vowed to maintain the EU and the euro in its current form, and because of these pressures, and particularly several of these attacks in Europe, has had to admit essentially that they made a mistake with the open immigration policy and is vowing to reduce illegal immigration, whatever that means. But the point is that she's feeling the heat and is definitely on the defensive and looking at strategies politically in Germany to try to save that. She is the leader of the coalition in Europe that wants to keep the EU and the euro together in its current form, and they are politically in trouble. If you look in France and the rise of Marine Le Pen, who is leader of the National Front, populist, anti-establishment, conservative, hardline against Muslim immigration particularly. One of the first foreign leaders to congratulate President Trump, the ideological opposite. She is now leading in the presidential polls for the April 23rd elections. They have a runoff between the top two finishers, but she is now pretty much decisively in first place. Now, the issue with that is that once they get to a runoff, will there be more widespread support for the National Front once the other candidates are eliminated? That's historically been a problem for Le Pen and that party, but it is becoming more and more likely now that Le Pen will be at least in the runoff, and that gives her a very good chance of winning the election. And she has vowed to take France out of the EU and out of the euro. That would be a major blow and could be the next leave, if you will, not Italy, but France. And France is, relatively speaking, one of the stronger countries in the euro. That would have much more dire implications, we think, than the Italy leaving scenario if France tries to leave. Back to Brexit, the first leave, okay, the British exit. What's the verdict? Pound sterling is down. It is stable, but it's still down from its highs. The London FTSE stock index, much higher, up almost 20% now, which is actually comparable to Europe in general. UK GDP happened at the end of the second quarter. Second quarter GDP in Britain was 0.6% positive. At the end of third quarter, after the turmoil of Brexit, again 0.6 positive. The reality is that the referendum to leave was in June of 2016. The actual leave is going to be a lot later. So the British still have to actually leave, and there are something like 43 trade treaties that would have to be negotiated, and then 30 parliaments that would have to approve this under most scenarios. It's not something that's going to happen very quickly. So the effects of Brexit, I think our point here is that they really haven't been felt yet, other than in a lower value of the British pound. So our conclusion is that there's a political movement across Europe as well as across the developed world that is anti-establishment, that is populist, that is a backlash against the forces of international corporate citizenship, open borders, and free trade. That's dangerous. The last one is dangerous. You know, arguing against free trade has historically been a precursor to, you know, falling economic productivity throughout the world. Um, Social issues, are they mutually exclusive? No, they are not. But what we see is that for the most part, these exit talks are really more about immigration and local control than they are about the economics. The economics, unfortunately, will follow if the leadership of Europe does not get their act together, in our opinion, and get the, you know, do a smarter and better job politically of integrating whatever immigration populations they're willing to take, or getting better control of their borders. They're going to have to get a better control of their employment situations and do a better job of, you know, keeping people employed. And of course, you know, the typical European solution is to kick the can down the road. As we mentioned, all the equity markets have essentially been up post Trump's election, France and Germany included. As we move to keep things rolling here, we're going to move to China now and take a look at what's been going on there. And it's hard to look at the Chinese economy without thinking that there has been a bubble developing there for some time. If you look at the growth in debt versus the growth in GDP, they've both been impressive, but debt has grown spectacularly harder and faster than the GDP growth. And that has accelerated, as you see here, since about 2012, when GDP has begun to fall in terms of the growth rate, while the debt levels are still rising dramatically. So what does that mean? Where does the money go? Well, one of the places is a housing bubble. If you look at this graph, you can see that in Shenzhen, on home prices, for instance, just as an example, the average sales price of a home has tripled in just 3 years, from you know, late 2013, 2012 area, about 20,000 to almost 60,000. That is obviously a concern for anybody in the U.S. who lived through the housing bubble and who had to look at what's happening afterwards. If you look at Bitcoin, we pulled this up because starting about 3 years ago or so, as Chinese authorities began cracking down more and more, instituting capital controls so that capital could not leave the country, all of a sudden Chinese participation in Bitcoin took off to the point where most Bitcoin transactions today are being, well, let's put it this way, 4 years ago, most Bitcoin transactions were occurring in China. Today, almost all of them are. This is a rather interesting phenomenon because at the same time, as you can see, the Bitcoin price from 2015 to 2017 has risen pretty spectacularly to the tune of, you know, 4 or 5 times inflation in Bitcoin. Why? Because wealthy Chinese are using Bitcoin to get the money out of the country. Now, there was a recent crackdown announced that, again, the Chinese authorities were looking at Bitcoin. Bitcoin fell spectacularly and has rallied since, starting at the first of this year. A lot of that volatility is coming now from China. So those are our international concerns. We promised to run you through what we think are the biggest issues, and what we think they are is essentially deflation potentially coming out of China if the housing and asset bubbles burst there, as well as the banking issues out of Europe. We see those as the deflationary forces in the world today, as against the inflationary forces that are perhaps coming in Trumplandia. So what we did was we went ahead and now I'm showing you on the graph here what Trumpland actually looks like. These are the precinct and county level votes where Donald Trump won in those precincts and counties, not by the state level, but by the precinct and county level. And you can see here that the more orange and red it is, the higher the percentage. And there's a lot of orange and red. Trumpland comprises over 85, it's almost now 90% of the area of the United States, people living in those areas. Whereas if we move on to the Clinton archipelago, the same graph for Hillary Clinton in the most recent campaign looks like a series of tiny islands that are probably very crowded, because those islands include places like, you can see my pointer on here, Seattle, San Francisco, LA. You get into the Northeast Corridor with Boston, New York, Philadelphia, down to Washington, D.C. and the coastal areas. Little enclaves like Chicago or Detroit, in Michigan, Minneapolis. These places are essentially the cities and the urban centers where Clinton and the Democratic Party have their most ardent support, whereas Trump is very rural and suburban in his support. So the point is that there are a lot of ways to try to determine someone's propensity to vote, and for the most part, income and age and race, with a couple of exceptions, are not very good predictors. However, where you live, urban, suburban, or rural, tends to be a very good predictor over time as to what your voting preferences are. It's not about who you are, it's about where you are. Or we should say it's just as much about where you are in America. And this explains a lot of what happened in particularly this part of the country, this upper Midwestern industrial area that has been left behind, if you will, by globalism as manufacturing has moved out. It's those areas that became much more red and much more Republican over the last 8 years. So who's in the stock market today? Who's winning and who's losing with this, with this new regime? So we put up here the sectors in the S&P 500 and their performance in the 1 year pre-Trump, from November of 2015 to November of 2016, and then from the next day after the election through today, what the stock market has done. Now, the numbers on the left are, of course, annual. They are annualized because they are a 1 year return. The post-Trump numbers, however, are just the last 2 months and change. So 2 months and a handful of days is those returns, and that's not an annualized number. So you look at the biggest winners on that chart. Banks and insurance companies. They were up, relatively speaking, 14.17%. After being up 2% in a full year, they're up 16% in just that period of time, that 2 months and 2 days. So what's the reason? Well, perhaps the Dodd-Frank repeal, as has been promised at various times, or at least a major overhaul of post-regulatory financial burdens to be rolled back. The market is telling you that Mr. Trump is probably serious about that he would be able to get a good portion of it through, and that perhaps this is why banks are doing so much better, is that their earnings would be expected to increase in such an environment. The second one's consumer discretionary. You can see down 1.5 points in the previous year, but now 7% up. Why would that be? Well, potentially more domestic jobs, if that were to happen, would be more middle-class income, and therefore more consumer discretionary dollars to spend, and higher and better top-line revenue for discretionary consumer purchases. That would be one potential explanation. Healthcare. If you look back here now at healthcare, which is a 573 basis point advantage, down 3% in the year before Mr. Trump, but now up 2.65% just in the last few months. Why would healthcare? Well, perhaps the market is saying that a repeal or a major overhaul of the Affordable Care Act would be good for health company profits. That would be one logical explanation for that sector. And finally, energy, which is also at 500 basis points. Stimulus is, generally speaking, good for the commodity markets, including oil and energy producers, as well as for the general economy. So you would see a bit more of an inflationary pressure. So therefore, in the energy sector particularly, would be one of the places where a deflationary or hardly a non-inflationary environment would change into an inflationary environment. That would be one of the sectors that would, in theory, be a winner. Who are the losers? Utilities. Utilities were up Pretty much 20% the year after Mr. Trump. Since then, those stocks have done nothing. Same for consumer staples, up 10, have done nothing since. So let's take a look at, essentially some of the potential explanations. Consumer staples is also a defensive sector, much like utilities. Utilities are generally speaking by higher interest rates. We've seen higher interest rates over the last 6 to 8 months, again after Mr. Trump was elected, although that seems to have stabilized for the time being. But generally speaking, utilities, if there is a higher interest rate environment coming, they are the ones typically hurt because of their financing costs and the cap on their allowed return on equity, as well as a sector that produces a lot of dividends. That tends to be a defensive sector, and it looks like defensive sectors may be out of favor. Consumer staples would be the same situation. Although a lot of consumer staples, if you look at a lot of the brands that are out there, the Procter and Gamble's of the world, that have a lot of foreign earnings, they would be hurt by a potential increase in trade barriers. You would expect that some of those companies that are defensive in nature, that are also very large and international in their revenue lines, would also be hurt. And finally, information technology. There are a lot of large international brands there with foreign earnings. There's a lot of foreign sales for the likes of Google and Microsoft and so forth. Apple, would they be hurt by a potential trade war? Absolutely. You would see a much more difficult time, perhaps, of the sale of those American-based companies in the international market. And there's also the potential, perhaps, that Silicon Valley did not like Mr. Trump and contributed heavily to Mrs. Clinton's campaign. Is it possible there is a political backlash aimed at those companies? They seem to think so, because a lot of them are scrambling now to try to find favor within the Trump administration. So that's the end of the formal presentation. I'll just add a couple of comments. If you take a look at our presentation, you would say that because of where valuations are, our prognostication is that equities are probably going to struggle over the next several years. Those valuations are historically very high. Earnings may be recovering, but in order for the equity markets to continue to push ahead, what we're going to need is explosive growth in both GDP and earnings. And unless that happens over the next year, which is possible but is probably not the most likely outcome, unless there's that explosive growth, the equity markets are going to struggle in order to have a higher price valuation point. Bonds are going to struggle because we are looking at a potentially more inflationary environment with the stimulus that the Trump administration is talking about. They would definitely not have 1%, 2%, and 3% interest rates anymore in an inflationary environment where 2% and 2.5% inflation was where we are today. If, as we now, the Federal Reserve is ending zero interest rate policy, you could very well see another 1% to 2% a return, we should say, the 1% to 2% inflation premium in long Treasury bonds. And if we get back to 2%, well, that's 4.5%, and we're sitting at 3% today for the long U.S. Treasury bonds. So it's very unlikely that Treasuries are going to produce, or corporate bonds are going to produce, outsized returns. I mean, the bond market expected return right now can't be much more than 2% to 3%. So bonds should struggle. That means portfolios will struggle, especially if, as we've pointed out, correlations which have been negative start to move back to an either zero or positive between the two main asset classes, stocks and bonds. So you lose the diversification power that you get when you go from stocks and bonds as a balanced portfolio. A lot of that will disappear. So the question then is, if the portfolio correlations are going down or becoming more positive, then higher portfolio volatility that includes the major asset classes is also inevitable. If those correlations go back to positive, you're going to see simply more volatility because you don't get the diversification power of non-correlated assets. So that's what we're looking for this year. We've also got several things that we're looking at as potential investment sectors. And that, I think, we will now open it up to questions and allow the attendees. I think we've got about 50 people on here, and we're trying to remove everybody from mute right now. Getting some help from Jennifer here, so we take all 50 of you off of mute and allow you to ask questions. Also able to time. I just muted them all again. That's there's a lot of noise coming from the from a couple of phones that are out there. So I think what we'll do is we'll simply, you can ask your questions online. We'll be able to unmute you at that point in time. If anybody has any questions while we're waiting for, I guess, potential questions here, we can mention that this presentation is available in PDF format that you can download off the site. We've made that available for anybody who wants to see it. And there's also a recording of this call so that you'll be able to listen again later, particularly if we get some questions. It doesn't look like we're getting any questions. So I'll give sounds like there's a couple of attendees that have a very high amount of noise or distortion on their phone, so I don't know that we're going to be able to take questions at this point unless we can take them online first. So we'll give everyone about another minute or so to take some online questions, and we'll try to answer them over the phone as we get them in. Looks like we might be having some technical difficulties here, in the sense that there's a couple of phones in the group that are in noisy locations, and we know that there's at least one or two people trying to get a question in, but it's not showing up here on our screen. So what I'll say is I guess we'll call an end to it here. And if you do have questions for us, please feel free to email to me or to Fred Slade, or to Chris LaMarca. The nomenclature for our email here is simply the first name dot last name at pentegra.com. So I'm at scott.stone@pentegra.com. Fred is at fred.slade, Pentegra, and of course Chris LaMarca is chris.lamarca. And you can see the correct spellings of those names on the opening slide. So with that, we'll thank everybody. Apologize for some of these technical issues here at the end, and hope you found some insight out of our little quick discussion here today. I know we ran through it rather quickly, but we did want to get through within 45 minutes, and I think we barely made that. So thanks again, and we'll look forward to speaking with you the next time we have a Pen Talk. Goodbye.